So very critical. Let's start with EPS. Now, the concept of EPS, okay? Before we start the concept, some people understand what exactly we mean by EPS, okay? Anyone know the full form EPS?
Earnings per share.
Earnings per share, right? So people online as well. EPS stands for earnings per share, okay? So basically, why do we compute this is critical. This stands for earnings for every share that you're holding. So it is not enough to know how much is the net income. It's important to know how much your net income per share, right? So every shareholder is interested in knowing what is EPS. Now this is the only ratio which has a lot of computations to it. It goes beyond the normal ratio where I need to find out earnings per share. So basically, if you see the formula, it's nothing but earnings upon shares, right? Now earnings means those earnings which belong to the shareholders. So the correct answer is the net income that belongs to shareholders, which is PAT, upon the number of shares, right? But which shares are we talking about? Equity shares or preference shares? Or all shares? Is it equity plus preference? No. This is only, okay, this is important. This pertains to only the equity shareholders. But this PAT belongs to everyone, right? Equity and preference. So I need to remember that I want to know what earnings belongs to equity shareholders. Correct? And for that, I will have to go one step further and remove all the preference dividend that belongs to equity shareholders. That belongs to preference shareholders. So if I remove the preference dividend, I am left with earnings for equity. Because this belongs to equity and preference. Preference nikala, then this belongs to only equity, and this is the number of equity shares, and this answer will give me EPS, equity shareholders earnings. Very critical. So please learn the concept, right? Understand why am I minusing preference dividend? Because normally it is paid after profit after tax. Okay? So therefore, this is nothing but earnings belonging to equity shareholders, right? That's why I did minus. Clear the formula? So everyone here knows formula, and that'll teach you how to compute this sum. Taking note of EPS, PAT minus preference dividend. Okay, let's start. So that's the basic formula. Net income minus preferred upon number of common shares. So in US, equity is referred to as common shares. Clear? And you now know why we are subtracting preferred dividend. Okay. Now let's try to find out how we compute each of this. Now, you know that net income and preference is very straightforward, right? Why weighted? Okay. Now, you know shares are basically outside for throughout the year. But it could be possible that some shares were issued at the start, at the mid, or at the end of the year. Or maybe some shares were bought back somewhere in the middle of the year, right? So I can't just take the shares outstanding at 31st March. This will be wrong. I have to take the shares outstanding throughout the year, right? And therefore, if some shares were bought, were issued or bought back, I have to adjust for the period. Therefore, I need to find out weighted number of shares. I need to find out weighted average. I can't find out just the closing outstanding. Clear? So how to work out weighted average? Okay, there's a very important working note for this. Let's understand how to work out weighted average number of shares, also called as WANOS. Okay, what you should do is try to break down a period. Let's assume US is obviously Jan to December. You need to find out how many shares were issued in the period and then accordingly compute the total number of shares. Example, let's say in this sum, I had 1 lakh shares. On 1st April, I issued 20,000 shares. on 1st July, I issued 30,000 shares. That means at the year end, I had 1,50,000. But I cannot take 150 as the shares outstanding because 150 contains 20 and 30 shares that were outstanding only for part of the year, right? 3 months, 6 months, only part of the year. So I have to consider only that part. Effectively, 20,000 shares were outstanding for only 9 months, right? Effectively. So I should take only 20,000 into 9 by 12, right? And 10,000 shares were outstanding for only 6 months. So there are two ways to the formula. Okay, let me teach you both the ways. You can find out. You can break it down to periods, right? If I said that 1st April something happened, I will try to compute 1 lakh shares was for how much time? Only 3 months. After that, it became 1,20,000. And that again was again for only 3 months. Then further 30, so yeah, 150, but that was only for the next 6 months. So by doing this, I am effectively getting 12 by 12, right? Which is 1, right? But I'm breaking down the number. So I am going to 1 lakh shares, 3 months. It became 120, it became 150. And the period, if you adjust this, so what is 1 lakh into 3 by 12? 25,000. Then 120 to 3 by 12? 30,000. 150 to 6 by 12? 75. And then I add 175, 25, I get 130. So instead of saying 150, the correct answer is 130 because notice that won't be equal because this is the closing and this is the amount outstanding for the year. And you need to find out EPS based on outstanding for the year. So that's WANOS. WANOS means weighted average number of shares. You unmute yourself online. Yeah. Are we clear? Sorted? So WANOS is important. The other is very simple. Once you got WANOS, you can simply take see the answer is 130. Okay, so the tough part is only computing WANOS. Clear? And every sum they'll ask you to compute WANOS. How do you do it? Break down the movement into periods. And how to find out which period? Decide when the movement took place, stop the period, start a new period. So here I have 3 periods. One, the first movement happened here, so freeze the period. Second movement happened here, freeze the period. Okay, I can have 10 movements, no problem. Okay, then you do the maths the way I taught you, got the score right. Clear? Made a note, guys? Very critical. Okay, how to break it down by period. Okay, now once you got this answer, you can then say find net income divided by WANOS is your EPS. So here I have net income is 2,60,000. Remove preferred dividend, nothing is there. Divide by 1,30,000, which is what you got. The answer comes to 2 rupees. Clear? Okay. Now this is basic EPS. Basic EPS means EPS without adjusting any potential shares. Okay. So I have computed EPS only for existing common shares. Existing. Right? That means as of today, I have 150, uska WANOS is 130, I computed for 130. It could be possible that in my balance sheet, there's some instruments that might become shares in the future. Right? Some instruments that are liable to become shares. What are the examples? Think. Very good. Convertible preference shares. See, this is my shares as of today. But in the future, I know that this will become 2 lakhs because I have 50,000 maybe convertible shares. So I need to now find out that if basic is existing, what is my future potential number of shares? Now let's understand the formula. You know that if I'm dividing PAT upon WANOS, which is number of shares, if suppose this was to go up, right, in the future, the number of shares increases. what will happen to the answer? The answer will go up or the answer will come down? EPS. EPS will go up or come down? Very good. If this goes up, the answer will come down, right? Because they did in numerator. So the EPS will basically dilute because of future conversion. But if you know the future conversion, you know that in the future they might convert. How you know? It is there in the balance sheet. I have converted debentures. I have converted preference shares. So I know that in the future my shares will go up because of conversion. And therefore my EPS will go down. So I need to tell my users that in the future there's going to be a dilution. So I want to tell them that my EPS is likely to dilute in the future, and that diluted EPS is what I want to give them an indicator of. Got it? And that is called diluted EPS. So we have basic EPS, which is based on today's scenario, and diluted based on future scenario. But you know the conversion will take place. You know it. It's not that tomorrow I'll issue convertible and then dilute. I am talking about those that are already issued. Clear? Those that are issued and are likely to convert. Okay? Clear? So you understand from the formula that on conversion, my WANOS will go up. But tell me, on conversion, is this likely to change? Is this figure likely to change when you convert? That. Answer. If you convert into equity shares, will the PAT number change? Guys, answer. Will the profit after tax number change? Huh? So if you convert, no, profits will also likely change. The reason is, if I convert convertible preference shares into ordinary shares, will I pay them preference dividend? So earlier I said PAT minus PD, preference dividend. Now I don't have to minus PD because I no longer have to pay them because they have converted. So on the day they convert, preference dividend is not payable. Understood? Okay, let's do another example. Let's say I have converted debentures. I was paying debenture interest, but the day they convert, will I need to pay debenture interest? Got it? And because I don't have to pay debenture interest, that will become a savings. Got it? So key learning. If I'm going to convert anything, my PAT will increase by the savings on conversion. And which will I save? I will save debenture interest because debenture is converted, and I will save preference dividend if preferred shares are converted. And in the denominator, I will add WANOS, which I already had. I will also add the convertible debentures shares plus the convertible preference shares. So I will add the savings of debentures and add the shares from debentures. I will add the savings of preference dividend and add the shares from the preference shares. Clear? See, if you're going to cancel debentures, I'll cancel debenture interest also. If I'm going to cancel preference shares, I'll cancel preference shares also. So numerator will increase by savings and the denominator will increase by the potential number of shares that will be converted. Are we clear? Any questions? Go on. So make a note. Basic EPS was PAT upon WANOS. Diluted EPS is now PAT upon WANOS, but you will add savings on top and you will add the shares in the bottom. Savings on conversion and shares that will be added on conversion. Simple. Make a note. So this part of the equation is basically everything to do with conversion. The conversion impact. Conversion impact. On conversion, I will save these two, and on conversion, I will have extra shares from these two. Clear? Make a note completely. EPS is PAT upon WANOS. Say PAT plus savings, PAT plus savings, and WANOS plus new shares. That's the concept. I'll teach you details later. Okay, make a note of this concept. So conversion impact is added. Clear? Okay, I'll clear it. Okay, now let's look at how to solve a summary. Okay, so let's look at summary formula. You already used to do this for basic, and you did this for basic, right? Now, as a result of conversion, you're going to start doing savings from preferred dividend, interest from preferred convertible debentures, and don't forget, 1 minus tax always there because interest is tax. And the shares that you are going to get from convertible preference shares from debentures going to be added. So connect the dots. This and this. This and this. Yep. So earlier it was this and this. Now you add this, you add this, you add this, you add this. Okay. Now there's one type of share that will happen in the future which does not have any savings, and that is called ESOPs. So basically, what are ESOPs? If I issue shares to my employees, I say, boss, you're doing well. You can buy shares of my company at discount price, but 3 years later, I'm giving you a reward for your hard work. Share price 100, you can buy from me at 60. But you have the right to wait for 3 years. After 3 years, if it becomes 200, you'll be like, happy to buy. But it becomes 40, you'll say, no, leave it, I'll throw it out. So those are ESOPs. When you buy ESOPs, the shares will increase, but there's no savings. So ESOPs is the only line where you add it to the denominator, but nothing is added in the numerator. Are we clear? There's no savings from ESOPs. So ESOPs will always give you diluted EPS. Got it? But I hope you understand, you are adding something here and something here. It is possible that what you add more, this is more than what you add here, right? Your savings could be more than conversion shares. Your savings could be more than conversion. So in that case, dilution will be opposite. It won't dilute, it might increase. EPS was 2, it might become 2.2, or it might become 1.5. Are we clear? Now, if it becomes 1.5, it's diluted. If it becomes 2.2, it is anti-diluted. Are we clear? So let's understand this, guys. If EPS has reduced your, because you increase the number of shares and you increase the savings, but it's reduced, that's called diluted. Are we clear? It is possible that when you convert, it may increase it or leave it unchanged. Okay, now listen very carefully to this logic, guys. Listen very carefully. So suppose my basic was in the earlier sum 2 rupees. I diluted, I added the savings, and luckily my savings was greater. So now my EPS became 3 rupees. Okay. After doing dilution, I got 3. How is it possible? Yeah, maybe I save some more. Right? Now tell me, basic 2 rupees. What is diluted EPS? This is a computation. It gave you 3. What will you report to the shareholder? Diluted EPS, 3 rupees. Will you say that? Will you say that? Why? What will you tell the shareholder? You say, my friends, your diluted EPS is 3 rupees. Will I do that? Huh? This is what the maths is showing. But is it really diluted? 3 is in fact going up. 3 is not going down, right? So how can I call it diluted? It is anti-diluted. Understood? 3 is anti-diluted. So what do? I need to ignore 3 and report 2. Learn this carefully. If your basic EPS does not go down, then there's no dilution. Tell the shareholder, basic is 2, dilute is 2, khatam. But if it goes down, then you tell him, basic is 2 and diluted is 1.5 or 1. So what's my key learning? Only when diluted is going down, you report. If diluted is not going down but remains the same or it goes up, you need to exclude. So you have to compute but report what you feel is diluted. So in sense, you need to either report the same as basic or lesser than basic. You cannot report more than basic because the diluted concept will go for a loss. Are we clear with the logic? So in the exam, solve the sum, do the maths, get the answer, and then check. If diluted is less than basic, then brilliant, you can report. But if diluted is more than or even equal to basic, then you ignore. Clear? Make a note of this. If dilute is less, then report. If dilute is more, then you ignore. Ignore it and do not take it into your computations.